Okay, well, welcome to session 2, night 2 of Nuts and Bolts of New Ventures. Let me give you a little overview of the evening. At the beginning, we have Rich Kivel, who's going to be talking about business models. And then after Rich's talk, we're going to have ask for 2 volunteers who would like to give a pitch. So think about that. If you would like to do one, we'll be asking for it after Rich, about an hour in. Be similar to what we did the other night, which is, 1-minute pitch and up to 2 minutes of feedback. Then we'll take a 5-minute break, and so they can set up the breakout rooms, and we'll go and have another breakout room session like we did last time to try to, help you form teams. And then after that, we'll come back on the second part of today. Joost Bonson was scheduled to give the presentation around organization and people issue, but he's had some family issues. So at the last minute, we had a fill-in who put together a panel, and I'll describe that more when we get there. A panel of entrepreneurs are going to talk about the people issues they've encountered and how they've dealt with it. So I guess that's what the evening looks like. Before we turn it over to Rich, for our TAs, Sam, Claire, any logistics issues we ought to discuss at this point?
I think we're set, but I'll be monitoring the chat in case anyone has questions for me.
Okay. Well, I'll do a very quick introduction to Rich. He's, all of our speakers are highly paid, $0, and we triple their salary every year. And like all of the speakers, they've got quite a big background and stuff. Rich, I first met as a judge at the 50K competition. Before that, I think he was in IT roll-up kind of thing. He left the competition judging to go work with one of the companies that came out of the 50K in healthcare. That put him over into the healthcare area. He's also an investor and an all-around experience and great guy. And I don't know what more to say, Rich, other than let you take it away.
No,
They
that's
don't want to
good.
hear you. They don't want to hear me.
No, that is great. Good. So I guess I'll kick this off. And can you guys see me and hear me okay? We always want to double check that before I start rambling on. Good. All right. So first of all, it's really wonderful to be back here. Every year I've had the privilege of doing this class and been lecturing at MIT for as long as I can remember. But this is by far my favorite class, and it's incredible to see how it's evolved over the years, not only with the sheer number of participants that we usually have sitting under the dome every year, but the diversity of the participants is outstanding. I think in the old days, we attracted a lot of the Sloan students, and then slowly we started seeing more and more people coming from the hard sciences, and the engineers and the biologists and the chemists and material scientists and others. And it's really fantastic to see that, because as we look at it's really this phenomenal convergence of great technology here at MIT. And for those of you that are looking to start companies, without a question, you're in the right place, and hopefully this will lead you towards the MIT 100K entrepreneurship competition. So please feel free to, if you have questions at all, I think many of you are on mute automatically, but you can send questions to the organizers. Sam and Claire are really running the show behind the scenes, and they're also the new leads for the MIT 100K. So if there's questions throughout the presentation, by all means, let them know, and we'll be in good shape to be able to grab those. So I'm going to attempt to share my screen. All right. Claire, does that seem to show up okay?
I cannot see your screen.
You cannot. All right. Let's try another setting. Let me just pull this over. Might be one of the challenges of working with two monitors is.
There we go. It looks like it's starting.
How does that look now?
We can see your screen. I think it's the presenter mode. We can see what slide is coming up next.
Got it.
I don't know if you meant to share a different screen.
Actually, just move. Give me 1 second. How's that?
Oh, it's good.
Is that the same problem or no?
Nope, it's good.
All right, good, fantastic. Great. So today, many of you, the workflow of the entire program of Nuts and Bolts is just outstanding because it really, walks us all through that entire process from sort of ideation all the way through venture capital raising, commercialization, et cetera. Today, I'm going to focus on one of the key components of successful businesses, which is, or businesses that have failed, depending how you look at it, which is really around the business model itself. And certainly, dealing with hard science and complex technology, very often we think the best technology wins. And I think most of us are well aware over the years that's not actually the case. Very often, the best technology doesn't win, but what does win very often is the best business model. And sometimes it's not even about the company itself or the products or services they're selling at all. It's how are they reaching the end user. So I'm going to just share with you some ideas, concepts, strategies, and positioning as you think through the company that you're either building or you're joining, or even a number of years from now. You may be sitting there in a big company that's starting a new division or starting to create a new set of technologies or tools or products. And one of the critical components is how do we bring this to the market, satisfy customers, et cetera. So I'm going to jump into this, and Claire, if there's any technical problems, please let me know. So the business model itself is defined in a lot of different ways. This for me is sort of, I think, the most accurate business model description or definition. And it's a little different than one I've used in the past, which is, a company's plan for making profit. The business model identifies the products, services, and the business plans to sell it, identified target markets, and anticipated expenses. So simply, a successful business has a business model that allows them to fulfill client needs at a competitive price and at a cost that does not impact the company's growth, that actually feeds the company's growth. So simply put, the business model has to tell you who pays, how much, and how often. And all of us as consumers, we have exposure to dozens of different business models, whether that be our Amazon Prime account is one particular business model, or it be our Netflix account, or it be us walking through the doors of Best Buy or Target. All of those business models are completely different. Even to old industries that at one point were essentially unchanged and immovable in so many ways. I could think about the automobile industry is probably a great example of that. Since probably the 20s or 30s, automobiles were sold through a very, very specific process. You had the manufacturer who had retail distributors known as dealers. Those dealers had certain licenses and rights to certain numbers of vehicles based on their sales and their performance and their volume. And we as consumers went in and we dealt with the salesperson at the dealer that gave us the test drive and told us what were the options and the things that we can add to the vehicle we wanted. That business model changed so slightly over the years. In fact, the only thing I think that was a significant change was certainly the internet giving higher levels of transparency to consumers. which allowed us to walk into a car dealer and actually have more intelligence than we ever had before. So the old adage of sort of the tricky car salesman started slowly going away. But again, that was not a major shift. What was a major shift was an amazing company that I'm sure all of you have heard of by now called Carvana. Carvana does not negotiate price. They will not go back and forth with you. There's no haggling. There's no car driving. There's no dealerships. Essentially, you buy your car online and it shows up by truck at your door. It's as simple as that. And it's an absolutely mind-boggling concept. And you think to yourself, why didn't this happen 10 years ago? But what you see sometimes is very smart businesses can change their business model and continue to be relevant. And other times, industries that refuse to change are completely disrupted by the Carvanas, by the Ubers, by the Airbnbs of the world. So let's talk a little bit about this. When we think about building a business, it really starts at the ideation stage, right? You really got a great idea. You think it's going to be impactful. You think about the growth stages. We've got to create a proof of concept. We have to think about how do we get this in the hands of some people that can tell us and bang on it and tell us whether it's actually good or not. You create the prototype. You ultimately then will probably raise some capital, whether that be in the traditional scientific sense, where you might be getting an NIH grant or a DARPA grant, or you might be getting capital from a governmental agency or a strategic partner. But ultimately, that allows you to further develop and validate your product. But you still, at that point, probably don't have a really solid business model until you actually get out there and completely understand the competitive landscape, who are going to be the paying customers, who's going to fund this, and how are we ultimately, if you take venture capital, which is what my firm does, is we invest specifically in technology and healthcare companies throughout Europe. So we have to think about how do we exit these companies at some point. So the business model is being developed by the company sort of behind the scenes. And then as they start to have these external factors, such as consumers, outside investors, boards of directors, partnerships, that also then shapes the way they think about their business and then ultimately how they're going to exit the business. So really moving through those stages is absolutely critical. But businesses fail, as we know. Very often, companies that we once relied on and we ultimately enjoyed experiencing their products or services, they ultimately evaporate. And because this is MIT and because we love technology, in general, I'm going to focus very much around technology companies as opposed to traditional businesses, such as real estate or construction or food and beverage. In just the past year, putting even COVID aside, there has been tremendous success and failures within the technology sectors. You've seen more venture funding going into startup companies than ever before. You're seeing higher valuations, almost unprecedented valuations, both in the private markets, but also in the public markets as well. And you're seeing companies that are exploding and other ones that are imploding at the same time. And the one consistent with many of those companies, especially the high profile ones, is that they did not explode because they ran out of capital necessarily. It wasn't because they didn't raise enough capital. Quibi is a great example of that. You know, Quibi is a failure that is so enormous and so public that it feels like a total outlier. This is a company that was founded by former Disney chairman and DreamWorks animation people like Kratzenberg. It launched in April of 2020, just literally just right around the corner from today. It's not a company that was founded 10 years ago and took time to implode. It was launched less than a year ago, and they brought in 1.75 billion in capital from literally world-class investors throughout the world. China, US, European, major partnerships with downstream apps like Netflix and TikTok. And you would think, what could possibly go wrong? They have they have more money, than you can possibly spend in an early stage company. The market capitalization is the equivalent of the GDP of a small country. But everything did go wrong, and it went wrong in basically 8 months after launching to the public. Quibi was shut down for good right in the very earliest part of December. And it really became one of these doomed failures that the business model itself and a number of other factors absolutely crushed the company. And don't be fooled. It wasn't about the technology, and it was not about the fact they just didn't have enough money committed to them. You could look at other examples like Essential, which raised over $330 million. That's a 4.5-year-old company. Their Series A in 2016 was $30 million. And it was founded by a whole bunch of rock stars, people that came from, Apple, and people that came out of some of the biggest companies. And their Series B funding a year later catapulted them into that wonderful world of unicorns. But even though they launched successfully, they had customers and reviews and other things, the whole concept about their technology and their business model was in question. The sort of phone's camera and the reliance on this sort of clip-on peripherals were an absolute disaster. They didn't think through that part of the business model. They didn't think about how they were going to ultimately attack new customer segments. And ultimately, they failed. Again, no shortage of capital. I won't go through each of these, but certainly I think that the next one is worth mentioning, which is Brandless. This was a company that sought to do what platforms like Shopify have been trying to help small businesses do, how to compete with Amazon in the e-commerce landscape. And at first, Brandless priced each of its products at a few dollars a piece. But ultimately, the business model really got stuck between a rock and a hard spot. And essentially, one attempt even to restructure the business was ultimately crushed. And even after $250 million of capital pumped into this company, they failed and went out of business. So these are things that, honestly, when I was a young entrepreneur, I often equated more capital we raise, the more likelihood we're going to succeed. And that capital itself buys you time and gives you permission to fail. And that might be true if you're a 40-year-old company that has billions in revenue and profits and multiple successful products. You can fail and you can continue to iterate and try new things on the market, and it won't crush the business. But when you're a new company that has 1, 2, maybe a handful of service offerings, products that are going to the consumer, no matter how much capital you raise, if your business model is significantly flawed, the company will stumble, and it will be virtually impossible to raise additional capital. And many of these companies, like Quantopian as an example, they took on so much debt that it became unserviceable. So I think, once again, the business model is critical. Here's a couple of great examples of flawed business models and too much capital. I'll pause there. If there's any questions, let me know. Claire, wave, holler, Sam. So why do businesses fail? So you always hear these statistics. 9 out of 10 companies fail, and that might be true, but not all companies fail for the same reason. Quite frankly, the largest percentage of companies fail because a lack of product and market fit. It's as simple as that. They failed to come up with a business model where their product, however good the technology was, no matter how smart the team was, essentially did not fit well with the particular target. The second biggest reason is marketing problems, which are very synergistic when you think about that. So if you do the math, you've got basically 56% of companies fail because of lack of product market fit and very poor marketing. But of course, those two things often exist together, because if you have a very poor product market fit, trying to figure out how do we spend our millions of marketing dollars is really, really difficult, and everything seems to fail. They may have started off with a strategy of going perhaps direct to consumer, and they thought they were going to dominate through a direct to consumer model, through internet ads, pop-up, etc. But there's no traction in the market. So they then change the marketing plan and they think they're going to go through distributors or partners, or maybe they need to be on the shelf somewhere. Ultimately, if you don't have a really good product market fit, which is your business model, you can throw millions at marketing, and marketing will not solve that problem. Without a good business model, everything else just crumbles. And the funny part is when you look at this slide, which is a great report that came out not too long ago, only 6% of failures are actually attributed to technical problems. And that really tells you, you don't have to have perfect technology, perfect software, perfect internet, beautiful website in order to be an amazing company. So jumping along here, just remembering, of course, the business model is not a business. It is something that is innovative, it's critical. It is the way that you develop a quality business. It allows you to tackle new markets and drive profitability. But there needs to be perfect synergy between ultimately what your business does and what are the things that you provide most efficiently to the consumers that are ultimately buying the product. Whether that consumer is actually an individual, like those of us that are on this Zoom call, or the consumer is Fortune 100 companies, or it's international governments. Regardless, whatever that product or service is, you have to make sure that there's synergy between the technology you're developing and those individuals you expect to be able to buy it. So I'm going to shift gears a little bit and sort of in an academic way talk about some of the components of a business model, because this is a question I get so often when I talk to students here and in Europe, where my company is based, is there's so many business models. How do we think about it? What are the, should we copy our competitors? Should we take a look at new, entirely different ways to approach a market? And there's no easy answer. But at the end of the day, there's a number of components to every business model. The value proposition is really the top one, which is what is the problem the customer is suffering from? What is the solution that you have developed or believe you can develop that addresses that problem? And what is the value of the solution from the customer's perspective? Because I see technologies very often. We look at both very complex deep tech companies, but we also look at healthcare companies. And sometimes the problem for the customer is very, very clear. And they've developed a solution for that. But ultimately, the value of that is so low that it's difficult to make a business around that. So as an example, in the healthcare space, one of the companies that I was involved with many years ago, we were developing a pharmacogenetic diagnostic tool that would allow psychiatrists to better predict what medicine a particular patient would respond to. And for those of you that are in that field, it's all around genetics and biomarkers and a lot of very complex algorithms. And this was a giant step in the field of personalized medicine. So there was a lot of things that were very sexy about this company, about the business model, helping clinicians make better decisions, helping patients get onto the right drug as soon as possible, as opposed to having the patient try drug one, come off the drug, try drug two, come off the drug, suffering the side effects, et cetera. And I think all of us have experienced that, when our doctor has perhaps prescribed something that works for many patients, but it doesn't necessarily work for us. It might keep us up all night, or we break out in hives, or whatever it might be. So everything about this business made perfect sense. It was a problem suffered by not only the patient itself, the end user, but also by the doctors themselves who were responsible for the health and well-being of their patients. But we had a big problem that was unforeseen. And it was the fact that we were dealing with a particular subset of the healthcare industry where drugs are so cheap that nobody wanted to pay for the diagnostic. because we were dealing with psychiatric medications as our first pillar of helping define responders and non-responders, the doctor said, this is wonderful. I love it, but I'm not paying $499 for this test every time I want to try, meet a new patient. I can just put them on the medication. It costs $6 a month. And if it doesn't work, I'll switch them in 60 days. So what you had there was this value proposition fell apart, which was that the solution from the customer's perspective was high. The solution from the clinician's perspective was high, but the cost benefit analysis crumbled because you could not get healthcare companies to pay this much if the total benefit was going to be here. However, other companies who approached the healthcare industry in a very similar way, but did it in different areas of disease, such as cancer, they're able to charge $1,000 or $2,000 or $3,000 for a test, and the healthcare companies will pay it every day. And the reason is because if that one test prevents a number of CAT scans or MRIs, or prevents a particular patient from going on to a chemotherapy that is not going to work, you're dealing with tens of thousands of savings. So it's something to always think about. Even though you have identified the problem, you think you've got the solution, everybody goes, this would be awesome. Ultimately, you have to think about what subset of the market are you in. So market segmentation is important. Who's that target audience? And then just moving along, think about where you are in the value chain. So we see this a lot with technology companies, that the company is absolutely convinced that their technology is going to be faster, greater, better than their competitors. But ultimately, the question is, where do they fit within that value chain? Is the firm's position designed in such a way that they're going to capture the most amount of value, or are they going to be paying value out to everybody else before they see a penny? Give you an example of this. All of us right now are sitting on phones and laptops and everything that have built-in cameras. Well, just a number of years ago, 4, 5, 6, 8 years ago, very few laptops had built-in cameras, and phones did, but the quality was deplorable. You would never think of doing a 300-person Zoom call on your phone 8 years ago. It was just not possible. A combination of the quality of the camera, the quality of the audio, videos, everything was just terrible. So there were a lot of companies that made a ton of money selling external cameras. And I remember going to conferences in every place where people always broke out their little external camera, and maybe it had a microphone built into it. So those companies did really well until ultimately every laptop manufacturer decided to put in a front, maybe even a front and back camera into their laptop. Many of those companies closed up, went out of business, even though their technology was far superior. Because the problem was they were no longer in the value chain. One company that's probably done this better than almost anyone, in fact, two companies. One is Microsoft and one is Intel. We buy a computer now, and essentially what we see on there very often is a little sticker. Certainly if you're buying a laptop, it's going to have a little sticker on it like mine that says, Intel Core something 12 processor inside. Intel doesn't own a single store. They do not rent shelf space at Best Buy. You can't buy Intel chips at your regular technology market. Intel figured out where they were in the value chain, and they ultimately realized the best way to capture the biggest piece of the market is to ride on the back of every laptop being manufactured. So they cut deals, just like the camera companies have, with Dell, with HP, with ThinkPad, Lenovo. They cut deals with all of these groups. So they figured out where they needed to be in the value chain, and that eliminated all of that marketing cost that would have eaten into their profits. They don't have to buy shelf space at Best Buy and put it into a beautiful box and do advertising in the windows. It's all done for them behind the scenes. So as you think about your business model and how you're going to approach the market, not only think about what we talked about earlier, which is the solution problem mix and sort of the economic component of it, but where am I going to define and make the most profit? And how do I do that? So just wrapping this up, revenue generation and margins is another way to think about the importance of your business model. Cost structure and profit margins are important in some companies, and in others, they're not important at all in the early days of the company, because the company's designed a financing strategy that allows them to overlook those things in the early days. So when profit margins and let's say just generally cost structure are unimportant, you have an incredible luxury where you can now think about other standards of measurement and go after those. So all of us are on countless apps and internet tools, and whether it be travel apps or dating apps or it be communication apps like Signal or others. If you can design a model where your technology is superior and people barely have to pay for it, you're measuring success in a different way. You're measuring success by number of users, as an example, and there's lots of other ways to do it. If, for example, your Dropbox, you might not measure success by number of users. You might measure success by the number of gigabits, terabits that are being stored. Ultimately, when your business model, I should say, when your company needs to then shift and actually care about things like revenue and cost structure and profit margins, and this usually and very often happens when companies go public, at that point, you have to think about a new way to approach your market. You don't have to have all this figured out at the same time, but that willingness to change quickly is absolutely critical. And then, of course, competition controls a lot. So unless there's questions, I'm going to sort of talk about business models as it relates to companies we all know. What are we seeing out there, and how has the world really changed and evolved as we as consumers change and evolve on a regular basis? So new models that have changed the world certainly are the ones that we're most familiar with. Everybody here has used an Amazon, a Facebook, Airbnb, Alibaba, Netflix, whatever, or all of the above. What those companies did from a business model perspective was breathtaking, truly, truly novel. If you think about each of those, other than Bitcoin, and Bitcoin also could be argued, not one of these companies essentially were approaching things the old way with a slightly different change. They were approaching old industries with an entirely new model of communicating and working with clients. Amazon, as we all know, is really the world's largest store. When Bezos started that company, and the case studies are absolutely incredible, it was about books. And why books? Well, because books are easy to ship. They don't expire. They don't have an expiration date on the side of it. They're not going to go bad. People like books. They don't return them. You don't have to worry about whether the book fits or not. And ultimately, books became an incredibly easy thing to buy and sell online. And this was at the earliest days of technology. So if I had an option of driving 25 minutes to Barnes & Noble or Borders or some of the others that are mostly out of business now, or I could just simply go on Amazon, buy the book, I would do that in a second. Or I can send 25 books out to every one of my employees without even thinking about it. They changed the way old businesses operate, and then they went even farther. And as most of you know, Amazon not only sells books, but they'll sell cars and tools and pretty much anything else you can get your hands on. But one of the most successful and profitable things that Amazon does is AWS, Amazon Web Services. So as you think about what we know about Amazon now, how it's approaching the media business, how it's approaching essentially data storage and security, how it's approached every industry it's entered, whether that be cosmetics, whether that be auto, they have done this in a very thoughtful, methodical way. Not everything they've done has been a success. But if Jeff Bezos, day one, tried to tell his investors that I have this idea and I'm going to create this website, and instead of going to Sears, people are going to come and buy chainsaws, and they're going to buy equipment and tools on the website. And instead of going to Barnes and Noble, they're going to buy books on the website. And instead of going to CVS or to a major department store, they're going to buy their makeup and their other products on the website. And I'm also going to open a grocery store. Obviously, the investors' heads would have exploded. They would have thought Bezos was completely out of his mind. What he did is he picked a business model that he could demonstrate would succeed. It checked all the boxes that we talked about earlier. It was competitive, it solved a need, it was cost conscious, it was profitable. They did not have any surprises. They didn't have to own their own planes. They were able to leverage the services of other shipping companies. But over many, many years, they've morphed into an entirely different type of organization. So it's a wonderful lesson in be focused, have a solid business model, be ready to iterate. And then once you started to build success, choose your next battle. And Amazon's done that, I think, better than anybody. I won't go through each of these, but I think each of you know that there's benefits and also challenges with each of these business models. Airbnb is a total anomaly. It's a great example, especially if any of you watched the public offering of Airbnb. Airbnb owns no real estate, but they have a market capitalization larger than the top 3 or 4 hotel chains in the world that own just billions and billions of real estate assets. Certainly, Facebook goes without saying that that's a model, although under attack on a regular basis, like Twitter. They've created essentially a data machine there, and they know more about us than pretty much anybody in the world except for Google. So the internet has changed the game, but each of these companies selected a business model that was unique in its own way, but demonstrated the key components of success.
We had a quick question about business models specifically related to nonprofits or businesses that balance profit with impact.
That's great.
Do you have any suggestions on how to balance business model with impacts?
Yeah, Sam, thanks for sharing that, and thank you to whoever asked the question. You know, this is such an incredibly important topic. I mean, as a venture fund, obviously we have an interest in making money, but we also have a very big component around ESG and really thinking around what are the environmental, the social, the global impacts of the companies we invest in. And what's really shifted, I think, is that boards of directors are becoming more diverse. And I think that ultimately companies can truly build business models that not only do good, but also allow them to pay people very, very well, take care of their shareholders, and think about each of the constituents in different ways. I would say that you could look at some of the case studies that are out there that have really proven to be quite successful, are very often in the apparel space, where you have companies that are doing phenomenal design apparel. They're bringing in textiles from different parts of the world. They're providing jobs to different parts of the world that would never been provided before. They're very conscious around the use of harsh chemicals on the environment. There's so many different ways to be environmentally, socially conscious. It's not like 10 years ago where you built a for-profit company or you built a not-for-profit company. Nowadays, there are many, many companies that fall into the not-for-profit side of the world that are generating incredible profits that they then, instead of putting them out to shareholders, right, in the form of dividends, they're rolling back into the company. And you're seeing that all around the world, whether it be in wastewater treatment facilities or it be in different types of materials. So I think the energy sector is probably another one where I've seen this done really well. Do you think that answered the question, Sam, or is there another piece there that I could possibly add to?
I will refer that to Alan Foster, who is the one that asked the question.
Great.
So unmute yourself if you have any follow-up.
Excellent.
I think it was great. Thank you.
Thank you, Alan. And it's such an important area. It's almost strange nowadays to meet entrepreneurs who show a business and all they talk about is I'm going to build it for X, I'm going to sell it for Y, and I'm going to make this. It's the maturation, I think, of the entrepreneurial mindset. You go back to many years ago, in the 20s, in the 1900s, the 1990s and the 2000s, where there was a lot of focus around just simply build it, flip it, sell it, boom, become rich and move on. And now from, the leading entrepreneurs in the world, sort of the Elon Musks or, the Richard Bransons, every one of them thinks about what is their impact on the world? What is their impact on the globe? And that was not an easy discussion to have with VCs on Sand Hill Road 20 years ago. They did not want to hear about your touchy-feely nonsense. They wanted to hear how you were going to make profit, ultimately go public or get acquired. But every one of those, the investors I deal with globally, they want to know, how is this going to change lives? How is this impacting the environment? And how is this impacting people in general? So it's a wonderful time to have that entrepreneurial hat on that also says we're doing good. And by the way, we're going to make money. But the good part about making money is we can do more good. So thank you. But talking about making money, IPO exits last year, and I alluded to this in my early comments, that putting COVID aside, which by all accounts is beyond compare from a standpoint of impact on society on a global scale. If you were an economist, and I'm not an economist, but I would imagine economists, their heads are really hurting right now because everything that you know about macro and microeconomics is counter to what has happened in 2020. You have unemployment going up. You have dozens of businesses failing that were generally stable because they were in the retail sector, they were in the consumer sector, food and beverage, et cetera. You have a global pandemic happening. You have economic strife as well as all sorts of issues with injustice in different markets. And at the same time, you have IPO market, private equity market, Bitcoin market, the SPAC market, which is an entirely different seminar. We could probably have a discussion around SPACs and the impact of SPACs on capital raising. Every one of those have gone up, which is just mind-boggling. You would think everything should go down right now, and we should be sitting here with, high unemployment, interest rates, in the very high single digits. Instead, we have interest rates near low of probably 0 to 3%. We have unemployment very high. None of these things correlate. And the IPO market in the US is just probably one of the greatest examples. If you look at the IPOs that have taken place with US tech companies, absolutely the largest in the world have taken place over the last 5 to 10 years. And even some of the largest ever took place just in 2020. If you look at Snowflake, Airbnb, and DoorDash alone, the IPOs that those companies did was absolutely breathtaking. For those of you that followed, the Airbnb IPO was so whacked that they priced the company at whatever number it was, call it 50, 45, I think it was the actual number. And before hour trading brought that opening price to well over 100. The SEC prevented them from opening on their opening day until the afternoon, so things calmed down. So if you think about that's insane. This is almost like the dot-com era before most of you were born, where there's just so much capital that if I buy it at 50, I could sell it for 70 at 9:35 in the morning, and then you'll sell it for 94 at 10:15, and then that person will sell it for 130. It's absolutely crazy. So what does this mean? So this is interesting. But what I think it means is that ultimately, if you have a good business model, a good technology, the ability to raise capital right now is unprecedented. But you don't want to be one of these companies that goes out, raises a lot of money, and ultimately becomes one of those top 5 disasters of 2021. So as you think through your business model, you can look at companies like these that are succeeding and say, what did they do right? What did they do wrong? What were the mistakes that somebody like Snap or Snowflake made in the early days? Because the press talks about the IPOs and the big market capitalizations, but some of these companies like, DoorDash, they were written off as dead just a couple of years ago. As a matter of fact, COVID is actually the reason DoorDash is valued at what it is today. They were written off as dead. So their ability to select a good business model and then be nimble enough to modify it based on the environment that they live in is why these companies have succeeded. And just sort of going into the final part of my presentation, how am I doing for time? Ooh, all right, I think we're okay. What I'd like to talk about here in this last little part is really around thinking about the numbers and what's important. There's an adage around, if you can't measure it, ultimately you can't control it. And behind a lot of these very, very successful IPOs, you have to remember, and even some of these private unicorns, that they have very, very costly business models. So when you look at 4 of the 5 mega offerings in the past 15 months, Uber, Lyft, DoorDash, Airbnb as an example, these are not profitable companies. What they have is a tremendous amount of capital, an absolutely outstanding business model, technology that supports that growth. But ultimately, the market is going to demand more from them. The market is going to say, whoa, how is this sustainable? How are we ultimately going to continue to expand? Is it going to be through mergers and acquisitions of profitable entities? Are we going to change our business model? But think about the cost component always, because as I said earlier, if your business model means you've got to raise a lot of capital now, and you're able to spend freely, choose a business model that allows you to create value through whatever mechanism it is that's important. Could be users, it could be top line installs, it could be number of downloads, it could be many other factors. Because sooner or later, you're going to need to change that business model, ultimately to stay competitive and also to satisfy the market. So let's close by talking about what matters and what needs to be measured. I had met John last year at the Kleiner Perkins conference. I guess it was 18 months ago. And John Doerr is one of the big guys at Kleiner Perkins Caulfield Buyers, and he's sort of the guy that was behind Google, and he was behind a lot of the world's most incredible companies. And he worked side by side with Sergey and Larry and others as they were building those companies. But John had come out of Intel, and what he had learned from one of the most, I would say, impactful business people of our time was that ultimately you have to measure everything that matters to your business, and it doesn't mean it's going to matter to the next business. And what he learned from the people at Intel was really how to develop a methodology to track every performance in a company, whether that be your sales team, which is always easier to track than your technology team, or your customer service team. I guess I'm giving a suggestion as to one of my favorite books, which is Measure What Matters. But I want to give you examples of what's measured. And I want you to think about how this ties to the business model of these companies. Because what matters to you may not matter to your biggest competitor, and that's okay. However, you need to be able to identify how are you going to continue to achieve success. Apple, as most of us know, is really the most profitable company in the world. They earn about 1.9 million US dollars per employee per year in profit, and that number has gone up. Facebook is another example of that, and Alphabet, which owns Google, is another example. And you can look all the way down the list to companies like Yahoo, who's a failing organization. Yahoo, which is basically struggling to survive, has gone through multiple CEO changes. There's no reason that Yahoo, with a better business model and better leadership, could not have competed more effectively with Google, but they were left in the dust. And they're probably going to go the way of many old search engines like Lycos and Alta Vista and many of the others that existed. Cisco is an example of a company who is actually very, very, very successful. But their revenue per employee is at the lower end of this chart, but at one of the highest ends from a company that actually sells hardware. They're a hardware company, so they've got a lot more fixed cost. And you can imagine, I don't know how many employees Cisco has right now, but they're earning revenue per employee of $684,000. So think about that. Even if you took the top executives down to the cleaning crew, the average compensation might be what? 200,000, 300, whatever the number might be. It's irrelevant. It sure as hell ain't 684,000. So for their industry sector, they're absolutely crushing it. They're absolutely crushing it. They're a hardware producer. They have to own fabs. They have factories, shipping, transportation, and they're earning more revenue per employee than somebody, that like Yahoo, who, as far as I know, doesn't have much to ship. So think about what matters in your business. What the hell do we need to measure here? How are we measuring success? And maybe revenue per employee is one way to do that. Another one, just for fun, might be profit per second. This was a great chart. I love these guys. Can you imagine, most companies wouldn't think about this, especially companies like the ones that I work with that are pre-revenue. But it's just a fun way of saying what's important to your company. And there's always a way to measure it. And if that ultimately becomes the value driver that allows you to achieve what's important to you, your investors, your board, whether that be we want a higher market capitalization, we want more profit, we want to do acquisitions, think about that. And this is a fun chart to look at, and all these slides will be available for you guys on the website. So just to, usually this is when we do the open discussion, a little hard to do with Zoom. So I'm just going to blast through these and make the end of my time. So we often talk about how Amazon innovates in ways that Google and Apple can't. Certainly they're able to do that in a lot of ways, but there's other companies that do that as well. Zara is probably one of the most innovative companies in the world of retail. What they've been able to do from a standpoint of taking high fashion and bringing it in at a consumer-based price is absolutely incredible. They keep very, very limited inventory. They change the stock in their stores on a weekly basis. An entirely different model than, let's say, Filene's or Bloomingdale's, that winds up having buyers purchase an entire season of stock 6 months before the season, hold that in inventory, and then they're stuck with 550 blue cashmere sweaters in Colorado that didn't sell because that wasn't in fashion this year. Groups like Zara have taken that just-in-time model as part of their business model and absolutely exceeded expectations and killed it. So in summary, think about these pieces. I'm always happy to chat with students after if you want by email or in any other way. Think about what is your value proposition, not just the value to the end user. What is the value to the entire supply chain, right? What is the market segment that you're going to be in? How do you add value from the time that you manufacture it through perhaps a distributor or a partner, a sales force, to ultimately the consumer? And ultimately, what are the revenue generation and margins that you need to remain competitive? And if revenue generation and margins are not critical for your business, because you're probably, let's say you're doing something that's very, very, let's say consumer-centric online, you have to think about a lot of these other components in a more serious way. If, however, you're building a medical device, you really have to think about these things in an entirely different way, because you're not going to measure success on number of users. You're going to measure success on revenue. And revenue is going to be generated based on the number of potential patients. Patients are going to be reimbursed based on much bigger forces, such as the FDA and other consumer groups. So every business is different, but these are the key components that really need to be there. And I really want to thank you guys for your time. I hope you got something out of this. And thank you, Joe and Claire and Sam, for all your work that you did putting this together.
Thank you, Rich. Some of the things you talked about got me to thinking about something that I found earlier this year that I'd like to share with you and get your comment on. It's about business models and valuation. So if you could, let's see, give me a sharing ability here. So this is something I stumbled across where people looked at the S&P 500 over the last 40 years, and they grouped the companies into 4 basic business models. There were asset builders, like your car companies. There were service providers that provide service, obviously. Technology creators, this would include people like Microsoft, Oracle, Amgen. And then there were network orchestrators, where they create a network of peers in a value chain in which the people interacted. And the thing that was sort of surprising about this, when we looked at the data, is that after the fact, it's not too surprising. The network orchestrators outperformed on every metric, whether it was valuation, compound growth, higher profit margins. And part of it is because they figured out how to sit in a delivery of value to the end consumer in a way that they could capture a piece of it without having to do all of it. So for example, Uber doesn't have to own the car. So I don't know if you've ever seen statistics like that. Do you have any comments or observations?
Joe, I got to tell you, that's outstanding, and I think it reinforces what we're all seeing as consumers, which is, we've entered this sort of what they call a sharing economy, and in the old-fashioned days, like in the 80s and 90s, we really valued assets. Everybody wanted to own a car or 2 or 3, and they also wanted to own everything, whether it be the DVDs or CDs or VHS or whatever might be on their shelf, or it be a million other things. And now, if you think about, because of the sharing economy, young people are not in a position where they feel any stress at all. Like, they don't need to own a car. Some of the wealthiest people I know, they Uber everywhere they go, and if they need a car for the weekend, they're going to jump in a zip car. So those network orchestrators are absolutely fantastic business models. The challenge, of course, is how do they aggregate enough users in order to make their model totally efficient and make it really, really valuable.
The thing that I took out of this, in addition to just looking at the numbers, it says, if you're an entrepreneur and you're looking at, you've got a customer that you're trying to deliver value to, after Bob Jones' talk yesterday, if you can think of a way of fitting into one of these models that would give you higher valuation, if that makes sense, then you ought to sort of focus on that. Doesn't mean everything everyone comes up with is going to allow you to shift to a network orchestrator, but if there's a natural progression that gets there, it might be a smarter move than to try to deliver the service, soup to nuts.
Yeah.
And so just a different way of thinking about it. Again, you have these, it's like you're trying to make a souffle. You've got all the ingredients. Do you have the recipe? The business model is like the recipe.
Yeah.
Yeah. So anyway, I was surprised when I saw it, and pleasantly surprised that somebody had done that kind of work. So let me stop the share here.
Yeah, it's amazing how low the asset builders and the service providers are on that in comparison to 20 years ago. The asset builders, they own the world, whether it be in the automobile industry or it be in the real estate industry. The more assets you had, the higher valuation you had. Thereby, you could do more things. You could hire more employees. You could take out more loans. You could better finance your business in general.
Mm-hmm.
And now we're seeing the world's most valuable companies have a fraction of the employees of their traditional competitors, and they have market capitalizations that are absolutely outstanding. Cost of goods sold reduced dramatically. Warehousing cost goes to zero. It's really quite impressive. A lot of opportunity.
So I guess we should ask if people have questions. This would be a good time. There's been some things in the chat, but we've got Rich's attention here for a little bit longer. I guess you answered all the questions.
I'm looking through the chat. It's my first time looking at this chat, but yeah, somebody asked, wasn't COVID, I mean, for DoorDash, absolutely incredible. If it wasn't for COVID, they certainly would have struggled. And you know, some of it's just shit luck, and some of it is actually business model modification. But COVID has certainly proven to be an incredible value driver for certain businesses. DoorDash certainly being one. If you think about other businesses, especially in the healthcare industry, in fact, a very good friend of mine, Dr. Jennifer Joe, who does a lot of work in personalized medicine and really thinking about the future of healthcare, put out a report recently on LinkedIn. The entire industry around direct to patient communications, monitoring, et cetera, and also remote online patient doctor visits exploded overnight. I mean, and that was an industry that wasn't just invented. You had companies out there trying to do this for a decade, and there may have been bandwidth issues 10 years ago, but even 5 years ago, companies that were trying to do simple doctor-patient communication on a Zoom call, the regulatory authorities were against it. The reimbursement authorities didn't know how to pay the doctors. It was just complete bottleneck. All of a sudden, boom, COVID happens. I can't go do my annual skin check at my dermatologist. I can't go to my doctor for 2 or 3 basic questions like I used to do because their office is closed. So overnight, you're seeing healthcare companies, especially in telemedicine, absolutely exploding. That would not have happened without COVID. We probably could look at a number of other companies that have succeeded during this very, very difficult time.
We have a hand raised from Kave. Sorry if I mispronounced that.
No, you didn't. That was perfect. Thank you. I just wanted your opinion on Smile Direct Club. It's just, I'm a dentist. It's kind of interesting to me. I'm not sure if you're familiar with them or not. They're the CAD CAM 3D scanning Invisalign competitor, and I believe they're embroiled in some lawsuits as well. So I was wondering what you thought about that.
Yeah, that's that's another interesting industry. I'm most familiar with Invisalign because they have become sort of the industry stalwart, and you know that sector much better than I. But as I saw Invisalign coming out, I mean, all of us were highly skeptical because for those of us that have kids, we're used to paying whatever $4,000, $5,000, $6,000, whatever the number is per kid for braces. So the concept of Invisalign was really phenomenal. What I think Invisalign did really, really well is, as opposed to trying to compete against the orthodontist that does braces, I believe that they were partnering with orthodontists and giving people options. That model itself was incredibly unique. I mean, talk about a unique business model. You're kind of disintermediating them in some way. You're disrupting an industry that's been around. I mean, I think, wire braces have been around for God knows how long. And they were coming in with an entirely different model, using complex technology in order to measure the mouth and so forth. These sort of followers, these copycats out there, I don't know enough about them. You see them advertised on Instagram everywhere, Smile Bar and all the other ones. I could see why there's probably lawsuits around the intellectual property, especially. But there is a big concern as a consumer when it comes to things like, your face, your teeth, your eyes. I think most consumers don't take high risks. They're not going to take a huge risk there. It's something that it's hard to recover from if it goes really bad. But I think the business model I appreciate most is probably the Invisalign model and how they were so innovative and how they partnered with the industry. And now you're seeing copycats come out like you do in every market.
Just a quick add-on point. I appreciate that. What I was referring to is there were actually a class action lawsuit by investors around their IPO. And that, I think this was in I think it was 2020 was their IPO, or 2019. Is that common? Do you see that a lot?
Honestly, very, very rare that you would see a class action lawsuit associated with the IPO itself. Unless there was specific activities that were misleading or false during the roadshow and essentially in the offering memorandum. I mean, certainly we all know stories of companies. Certainly Theranos is a great example of that. They never went public, of course, but where there were class action lawsuits associated with essentially the falsification of information from Elizabeth Holmes, even though they raised, $1 billion or something, which is essentially the equivalent of a public company. I don't think IPO lawsuits are that common because typically when a company goes public, the initial buyers in the IPO are very sophisticated institutional investors. If, however, they went public through a mechanism where they have many more retail investors and they were making claims that market cap or revenue were going to hit certain things, or they falsified information, I can imagine that would happen. But I don't know enough about this case. But it's not often that you see a shareholder lawsuit unless there's some serious wrongdoing.
We have another question from Jan.
Yeah, it's Jan actually, but thanks for speaking to us, Richard.
Thank you, Jan.
Can you just speak a little bit more to the disconnect between the economy and the stock market, that K-shaped recovery that you talked about, how we're seeing the country struggle versus the, technology companies do very well? And secondary question to that is, how much of the valuation, the high valuations you think is actually like, true healthy fundamentals as relating to revenue versus hype? It just seems like untenable in some ways. So hoping you could speak a little bit to both of those.
Yeah, thank you. To the first point, I think what you have is a very, very unique curve that's not economically predictable in many ways. Using traditional economic models, I think if you take a look at the fact that there are significant numbers of outlying, let's say, market factors, such as the companies you're seeing now that are being funded to exorbitant levels and IPOing at exorbitant levels, those companies are being funded by capital from investments that were 5 years ago. So what you just happen to have here is a very unique sort of cyclical process where it isn't as though suddenly the public markets as well as the private equity venture capital markets suddenly just found all this money. It happened to be that venture capital funds and private equity funds raised billions and billions of dollars between essentially 2013 and 2020 and put that money to work. And many of the companies they were investing in 2012, 13, 14 were going public or providing returns in 15, 16, 17, and 18, and even 19. What was happening in those years in 17, 18, 19 was the fact that you had very, very low global interest rates, literally almost a zero interest rate environment. So investors they were not going to make money keeping their money in the bank. So they needed to pump money into the private equity world. That then give the private equity companies a lot more ability to invest in high risk companies. Big companies, right? Your behemoth companies, the Johnson & Johnsons, the PerkinElmers, the Intels, they're sitting there with overinflated stock prices in many cases. And they need to continue to grow. How do they do that? Well, if I'm the CEO of Intel, I have a choice. I could buy a company with cash. I could buy a company with my stock. Or I could take out pretty much a zero interest loan from Bank of America and other lending institutions and buy companies that way. So what you then saw was an incredible insurgence of mergers and acquisitions happening in 15, 16, 17, 18. And a lot of those were done by capital that was being borrowed at these zero interest rate environments. So all of this capital influx, and keep in mind, that capital that went in to buy that company that now Intel owns, or Abbott owns, or Google owns, all of those investors got incredibly wealthy and they have more liquidity. So now 2020 comes and the shit hits the fan. They were already sitting on their fund or their accumulated billions that needed to be deployed. They can't just put that in the bank at zero interest and all go home and say, well, let's see what happens when COVID ends. They have to deploy the capital. So what you're seeing, especially in the United States, and this part of the reason that my fund is focused in Europe is, and this now I think goes to the second part of your question, I hope, the answer is absolutely yes. These are grotesquely inflated, absolutely insane .com era bullshit valuations. Simple as that. Stupid as possibly can be. So how does that happen? Well, it happens because, very simply, nobody's betting on the value of the company. They're just betting that the next person is, let's say, more stupid than them. So I paid $150 a share for that company. I'm just gambling that this next idiot's going to buy it from me for $175. And the person that buys it $175, they're like, shit, we're going to raise a Series C at $250. And these next guys are going to come in, they're going to pay $250 a share. And this is what's taken these valuations through the roof. Because if you're, and I don't want to name names, but if you are any one of the top venture capital funds in the United States, if you're sitting on $2 billion in your last fund, you need to make 10, 20 investments over the 4-year investment period, let's say. You've got to deploy a shitload of money in a really small period of time. So let me give you an example. If you are running a hot company, great people, a bunch of smart folks from MIT, it's great technology, you've got a couple of beta users, whatever, and you're in a hub like New York, San Francisco, or Boston, and you knock on the door of one of the top 5 venture funds in that area, and they like your deal. And then you talk to another one that likes your deal. These venture funds have no choice but to deploy capital. They are going to artificially bid up your valuation. Complete bullshit, right? You go in and you say, listen, we want to raise 10 million in a pre-money at 25. The venture guys say, what if we give you 20 at a pre-money at 50? I need to deploy this capital, right? So they do a 20 at a pre-money at 50. And then the CEO says, well, this sounds pretty good. Why don't I go talk to the guys on the West Coast? And they're willing to do 50 million at a pre-money at 110. If you are a venture fund with $1 billion under management, does it really matter to you whether you paid a pre-money valuation of 70 or you paid 90? It's a freaking rounding error. It's a total rounding error because you're looking at $1 billion exit. So what you're seeing in the US is an absolute incredible artificial inflation. It goes back to the principles of marketing and economics 101. Supply and demand. There is more capital and less deals to invest in, which means the hottest deals are going to get more capital than they deserve. It's like buying a piece of real estate in Back Bay, Boston, or buying a piece of real estate in Mayfair in London. If the market's hot, someone's going to outbid you. It doesn't mean the property is really worth that much more. It just means that you were selling for $2 million. There's 3 people bidding. I'm willing to pay 2.4 because I want that house. And that's exactly how investors think. So that puts more more money into the market and allows companies to potentially succeed or make really, really bad decisions with other people's money. The reason we invest in Europe is because the valuations are actually substantially lower. And there's not that competition. I could be chasing the hottest company in London, Paris, Luxembourg. And you know what? There's 2 VCs to talk to in the city. There's 4, maybe, if you're lucky. So we're able to control the valuations, grow the companies, keep cost very, very reasonable, and then exit in the United States. I'll stop there. Sorry, John.
No, it's great. I'm just looking at time here. Probably makes sense to switch to a couple of pitches and get your reaction to them. And then we'll...
Thank you all again for listening to me just ramble on. This is the problem with Zoom call.
No, it's great stuff, but Okay, who's in charge of picking someone there?
It looks like we have some people that volunteered in the chat. So the first up would be Alan Foster.
Hey, what's up, guys? Can you hear me?
Yeah, so 1 minute pitch and a couple minute feedback.
All right, can you guys hear me?
Yep.
Okay, you can hear me. Yes, good, perfect. Here, I got a link right here. So my name's Alan. I am launching a startup company called the Founder House, which is a co-living space where entrepreneurs and startup founders can live together under one roof and work on their startups. It's a relatively simple idea. It's been done before. The idea is that we're going to designate a section of the house as a home office, and collectively we can redeem the home office deduction so that you can deduct your personal rent as a business expense off of your startup. So normally you can only do like maybe 20% of your rent. We believe we can get that closer to 70%. The rent is $1,500 per month, which is kind of expensive, but we include, cleaning fees, fully furnished, everything else like that. And we're hoping to launch it in September, and we're looking to acquire a property over during the spring. And that's pretty much it. I guess my name's Alan. I'm the one of the co-organizers of the Boston EdTech Meetup Group and a founding director of the Boston EdTech Foundation. And I've been working on a Udemy course to train community moderators how to manage communities. So that's what I've been doing over the past summer too. So.
Rich, you have some thoughts about that?
I mean, first of all, very interesting model, especially, as we were talking before about the sharing economy. I think that the co-working space really exploded with WeWork and demonstrated a lot of issues, especially because of COVID. But the co-living space, Alan, that you're talking about, reminds me a lot of many of these articles that I read of countries that are right now providing these specialized work visas. So you can go live and work on an island with high-speed Wi-Fi, and it's sort of this very cool model. And if you're a hot shit young entrepreneur or software developer or creative person, why put yourself in a position where you need to sit there in your apartment on the third floor of a building at Waltham?
My dick down to my jizz drown. Everybody wanna suck my dick for little kids now. Man, I wish my penis probably could've seen me gay now. Dick down, baby, stroke up, blow a dick down. Time go by, dick expect.
Did everybody hear that music, or was it just me?
One false nut and this dick gon' bust black. We gon' jack off for a dick.
Joe, is that your favorite song?
Absolutely. Okay, let's do one other pitch and then we'll do the break again.
Alan, really like that idea. I would just say, just in closing, because I think I like the idea, but the areas I'd be very, very cautious about is what industry sectors are you actually bringing into this living space, because you run into a little bit of an issue if they can't pay their rent. It's not as easy as throwing out somebody that didn't pay their rent at the Cambridge Innovation Center. The fact that it's a living space, there's all sorts of protections associated with the fact that they live there. What do you do in that particular case? So probably being very careful about who's coming in through that particular space to eliminate that risk. But I love the idea. And shit, if I was 25, I'd move in.
I think time-wise, we'll probably just do this, make that the only one, because I don't want to go too far into the other panels. So, Rich, thanks once again for coming. If everyone can, do a hand clap like that for you.
Thank you all.
Excellent.
You guys are great.
And feel free to stay on. We're going to
stay on. I'll turn off my camera. And thank you guys all so much. This was excellent. And best of luck. 2021 is going to be a great year.
Okay, and the check's in the mail for your speaker fee.
Awesome. Yeah. All right. Thanks, guys. Bye-bye.
Okay, and so we'll do a 5-minute break, and then we'll go to breakout rooms.